What if I told you that one of the most traded commodities on the planet has a price that doesn't fully reflect what's actually happening on the ground? Not because of some shadowy conspiracy, but because of a very real, very measurable gap between the paper market and the physical world. Today we're talking about silver, and before you think this is just another silver to the moon video, stay with me, because the data we're going to walk through is genuinely unusual. This isn't about hype. This is about understanding a structural shift that a lot of mainstream financial media isn't connecting the dots on yet. My name is John Smith. Welcome back to the channel. If you're new here, we cover money, markets, and the economic forces that shape your financial life in ways that actually make sense. No jargon walls, no fear-mongering. Just clear thinking about what's happening and why it might matter to you. So let's get into it. Let's start with something fundamental, because it sets up everything else we're going to talk about. Silver has two prices. Most people don't realize this. There is the spot price, the number you see on your phone when you search silver price today. And then there is what you actually pay if you want to hold a physical silver bar in your hand. Right now, those two numbers are meaningfully different, and the gap between them is one of the first clues that something interesting is happening beneath the surface of this market. The spot price of silver is largely determined by what's called the paper market. This is the world of futures contracts, derivatives, and financial instruments that trade enormous volumes of silver on exchanges like COMEX, the commodity exchange in New York. When big banks and trading firms negotiate these contracts, they're mostly settling in cash. Very little of that trading ever results in actual silver changing hands. So the price that gets broadcast to the world is fundamentally a financial price. It reflects bets, hedges, and positions more than it reflects the actual supply and demand of physical metal sitting in a vault somewhere. Now here's where it gets genuinely interesting. When you look at what's been happening at those vaults, specifically the registered vaults at COMEX, you see a story that the paper price isn't telling. Registered silver is the metal officially approved and logged for delivery. It's the silver that backs the contracts. And over the past couple of years, the amount of registered silver sitting in COMEX vaults has been declining significantly. We're not talking about a small dip. At certain points, the decline has been dramatic enough that analysts who track this closely have flagged it as one of the more unusual vault movements they've seen in decades. Think about it this way. Imagine a bank that processes millions of dollars in checks every day, but the actual cash in the vault is quietly walking out the back door. The checks keep clearing for now because the system still has enough to function. But the gap between the volume of financial activity and the physical backing of that activity is growing. That's not a perfect analogy, but it captures the spirit of what's being observed in the silver market. The paper market is enormous. The physical supply is tighter than it looks. Now let's bring in the second piece of this puzzle, because this is where it gets even more interesting. China. Over the past few years, China has been importing silver at a pace that is genuinely historic. We're talking about record-breaking numbers. In certain months, China's silver imports have been so large that analysts have had to go back through decades of data to find a comparable period, and in many cases, they couldn't. The volumes are that unusual. Why does this matter? Because China is simultaneously one of the world's largest manufacturers of solar panels, electronics, and electric vehicles, all of which require significant amounts of silver. Silver isn't just a shiny metal you put in a jewelry box. It's a critical industrial material. It's used in photovoltaic cells, the components inside solar panels that convert sunlight into electricity. It's used in electronics for its unmatched electrical conductivity. It's used in EV battery systems, medical devices, and water purification. The industrial demand for silver has been quietly building for years as the global economy pushes harder into green energy and advanced manufacturing. So when China is pulling in record quantities of silver, it's not just financial speculation. A meaningful portion of that silver is going into real things being made and sold. It's leaving the global pool of available supply and becoming a solar panel or a circuit board or a vehicle component. And once silver is used industrially at that level, it generally doesn't come back. Recycling rates for silver used in industrial applications are relatively low compared to gold. Silver used in a solar panel is, for most practical purposes, gone from the investment market. Let's slow down here and make sure the picture is clear, because this interaction between industrial demand and investment demand is at the heart of what makes silver's situation unusual right now. Gold is primarily a monetary and investment metal, About two-thirds of gold demand globally is for investment or jewelry. Silver is different. Roughly half of silver's demand, sometimes more, comes from industrial applications. That means silver's price doesn't just respond to what investors are doing. It responds to what factories are doing. And right now, factories around the world, especially in China and Southeast Asia, are doing a lot. Here's what this means practically. When investment demand for silver rises at the same time industrial demand is also strong, the pressure on physical supply can compound in ways that are difficult to manage quickly. Mining is slow. You can't flip a switch and double silver production. New mines take years to develop. And here's a structural quirk most people don't know. Roughly 70 to 75% of silver globally is produced as a byproduct of mining, other metals like copper, lead, and zinc. So silver supply isn't even primarily controlled by silver miners. It's a function of what's happening in base metal markets. That makes silver supply genuinely inelastic in the short to medium term. Now let's bring in the third layer of this story, because this one involves the institutional world, and it's a shift that has been building quietly but is now becoming harder to ignore. For decades, the dominant safe haven asset in institutional portfolios was government bonds. If a pension fund, a sovereign wealth fund, or a large insurance company wanted to balance their equity risk, they bought bonds, particularly U.S. Treasuries. The logic was simple. Bonds pay interest, they're liquid, and when stocks fall, bonds typically rise. It was the foundational assumption of portfolio construction for most of the last 40 years. That assumption has been under serious stress. The period of ultra-low interest rates after 2008 fundamentally changed the risk-reward math on bonds. And when inflation ran hot in 2021 and 2022, bonds could actually lose you real purchasing power even while technically paying interest. The 2022 bond market was one of the worst performers in modern financial history. Institutional investors who had trusted bonds as their safe haven watched their bond portfolios collapse at the same time their stock portfolios were falling. That was a wake-up call for the industry. So what do large institutions do when a core pillar of their portfolio strategy stops working? They look for alternatives. And one of the alternatives gaining serious traction is precious metals, specifically gold and silver. Central banks around the world have been buying gold at a pace that, in some years, has been the highest recorded in decades. Countries that had been net sellers of gold for years have become net buyers. That shift in behavior from central banks is significant because these are long-cycle strategic moves, and where central banks lead, institutional money tends to follow. Some of that institutional interest is now spilling into silver, not just gold. Silver has historically traded at a significant discount to gold on a relative basis, what's called the gold-to-silver ratio. When that ratio is historically elevated, sophisticated investors take note. A high ratio means silver is relatively cheap compared to gold, which has historically attracted interest from investors looking for asymmetric upside. Now I want to be careful here and acknowledge something important, because intellectual honesty matters on this channel. None of what we've discussed today is a certainty. The silver market is complex, and there are legitimate counter-arguments to the bullish narrative. Silver has been in a state of imminent breakout according to various analysts for quite a few years, and the price hasn't always cooperated. Markets can stay mispriced for longer than investors expect. The paper market is large, liquid, and deeply entrenched. There's also the reality that economic slowdowns can suppress industrial demand. If global manufacturing slows, if the energy transition hits policy headwinds, or if China's economy faces a prolonged downturn, then the industrial demand thesis for silver weakens. Silver is not immune to macroeconomic gravity. It's not a one-way bet. Anyone who tells you it is should be approached with caution. And it's worth acknowledging that the narrative around COMEX vault drawdowns has circulated in alternative finance spaces for years, sometimes with more heat than light. Not every vault drawdown signals a crisis. Sometimes silver moves between vaults for perfectly normal logistical reasons. The key is the sustained trend over time, not any single data point. And the sustained trend, looked at carefully, does show a meaningful reduction in registered inventory relative to the open interest of paper contracts. That's worth understanding, even if it doesn't tell you exactly what happens next. If you're finding this kind of analysis useful, this is exactly what we dig into regularly on this channel. If you're not subscribed yet, hit that button. It helps the channel and means you won't miss the follow-up videos we're planning on this topic. No pressure, just letting you know it's there. Let me pull the threads together into a clean mental model, because we've covered a lot of ground. What we're looking at with silver right now is a convergence of three distinct forces: a structural supply tightness, COMEX registered inventory declining, mining supply that can't ramp up quickly, and a significant portion of new supply already committed to industrial users. Second, an unprecedented demand surge from China, both industrial and financial, absorbing physical supply at a historic rate and removing it from the global pool of investment-grade metal. Third, an institutional pivot away from government bonds toward hard assets, driven by the experience of 2022 and ongoing concerns about sovereign debt levels globally. None of these forces is individually new. What's unusual is their convergence at the same moment. Each one alone might be a footnote. Together, they form a pattern that serious analysts are paying attention to, even if the mainstream financial press hasn't fully assembled the story yet. Here's a simple way to think about the silver price you see on your screen. That number is a negotiated financial price, the outcome of enormous volumes of paper contracts trading hands between sophisticated institutions. It reflects a lot of things, but it doesn't fully reflect physical silver being drained from vaults, absorbed by Chinese manufacturers and solar panel installers, and quietly accumulated by institutions rethinking what safe means in a world of rising debt and inflationary uncertainty. The paper price and the physical reality can diverge for a long time, but history suggests they don't diverge forever. Let me also bring up something that doesn't get enough attention in these conversations: the geopolitical dimension. We are living through a period of genuine realignment in the global financial system. Countries that hold large US dollar reserves are asking what happens if those reserves become subject to political pressure. The answer many of them are arriving at is, hold more hard assets. Gold has been the primary beneficiary of this thinking, but silver is part of the conversation too, particularly for nations that are simultaneously large industrial users of the metal. China's position here is uniquely interesting. China is both a massive producer of silver and a massive consumer of it, and yet China has been a net importer at record levels. When a country that mines a lot of something still needs to import record amounts of it, that tells you something meaningful about where real demand is sitting. There's also the energy transition story, which is probably the most underappreciated driver of silver demand over the next decade. The global push toward solar energy is not a marginal trend. Governments around the world have made commitments to solar expansion that will require enormous quantities of silver. Each solar panel uses a meaningful amount of silver paste in its electrical connections. Multiply that by the billions of panels that policy targets call for, and you get a demand number that is genuinely large. The irony is that the global transition to clean energy, which is supposed to be good for the planet, places enormous pressure on the mining of metals like silver, copper, and lithium. The green energy revolution is, at its foundation, a massive mining story, and silver is right in the middle of it. So where does all of this leave us? Here's the honest, balanced takeaway. We are in a moment where silver's paper price reflects a financial system that was largely designed before industrial demand from the energy transition was a significant factor, before China was absorbing record quantities of physical metal, and before institutional investors had experienced the kind of bond market breakdown that happened in 2022. The assumptions baked into that pricing system may be due for an update. Whether this translates into a near-term price movement, a gradual repricing over several years, or something else entirely, that's genuinely uncertain. Anyone who tells you they know exactly how this plays out and on what timeline is selling you a story the data doesn't support. What the data does support is the idea that there's a meaningful structural tension building in this market that deserves serious attention. For the everyday investor, the takeaway isn't to rush out and buy silver tomorrow. The takeaway is to understand what silver actually is, both as a financial asset and as a critical industrial input, and to think about whether these dynamics have any relevance to your own financial picture. Portfolio construction is deeply personal and depends on your goals, timeline, and risk tolerance. But understanding the forces shaping individual assets makes you a more informed participant in your own financial life, regardless of what specific decisions you make. Quick summary of the key points. Silver has two prices: a paper price set by financial markets and a physical price reflecting real-world supply and demand, and those two have been diverging. COMEX registered vault silver has been declining significantly. China has been importing silver at record levels, driven by its massive industrial base and the energy transition. Institutions are pivoting away from government bonds toward hard assets following the 2022 bond market shock. Silver supply is structurally constrained because most of it is a byproduct of other mining. And the energy transition is creating a long-duration structural demand driver for silver that simply didn't exist at this scale a decade ago. That convergence of supply constraints, record physical demand, institutional repositioning, and a massive new industrial use case is what makes silver's current moment worth understanding. Whether you decide it belongs in your financial picture or not, at least now you have the full picture of what's going on. Thank you so much for spending this time with me today. If this video gave you something to think about, sharing it helps other people find content like this, and it genuinely supports the channel. Drop your thoughts in the comments below. I read them all, and I'd love to hear how you're thinking about precious metals and the broader macro environment right now. If there are specific topics you want us to dig into next, whether it's gold's institutional story, the copper supply chain, or how COMEX actually works, let me know. We'll put it on the list. Take care of yourself, keep asking good questions, and I'll see you in the next one.